If you want to really understand Hyperliquid right now, not just the price going up or down, but what is actually happening behind the scenes and what that could realistically lead to next, this is the only video that you need to watch. Hyperliquid is at a point where everything feels confusing on the surface. The price is falling, people are talking about massive token burns, traders are getting liquidated, and at the same time, institutions and big platforms are quietly paying attention. In this video, I'm going to break all of that down in very simple terms. I'm going to explain what Hyperliquid is doing, why the market is reacting the way it is. By the end of this video, you will understand what's going on and why it matters. Right now, if you only look at Hyperliquid's price, it's easy to think that the project is failing or that nothing is working, but that's a very shallow view. What's really happening is more complicated. Hyperliquid is trying to become three things at the same time: a trading platform that earns real fees, a fast blockchain that other apps can build on, and a future hub for things like tokenized stocks and advanced markets. Meanwhile, the market is treating its token, the HYPE token, like a risky asset that should be sold whenever fear shows up. That clash between the long-term building and short-term fear is the core story here. One of the biggest talking points recently is the assistance fund burn. In simple terms, Hyperliquid automatically uses trading fees to buy its own token, and those tokens go into a special address that has no private key, which means no one can access or spend them unless the entire system is changed. Now, the foundation is asking validators to officially recognize those tokens as permanently gone or burned, so they are no longer counted as part of the supply. On paper, this sounds huge because we're talking about tens of millions of tokens that are worth over $1 billion. But here's the important part that often gets missed. These tokens were never going to be sold anyway. They were already locked. The vote doesn't suddenly remove sell pressure tomorrow. What it really does is make the rules clear for the future, especially for the institutions that care about how supply is calculated and whether it can be changed later. At the same time, new tokens are being unlocked for developers and contributors, and some of those tokens can be sold. So, even though Hyperliquid is reducing supply in one place, it's increasing supply in another. That's why the market feels confused. Long term, the system is designed to slowly reduce supply as trading continues. Short term, new tokens hitting the market can push the prices down. Traders usually react to what's happening now, not what might matter, a year from now. This is why you're seeing headlines about massive burns while the price is still weak. You can also see the confusion in trading activity. Volumes are lower than before, fewer people are actively trading, and when the price drops, it drops fast. Many traders were betting on a quick bounce just because of the burn news, and when the bounce didn't happen, their positions were forced to close, which pushed the price even slower. This creates sharp drops that feel scary, even if nothing fundamentally broke. Importantly, these liquidations are not the cause of the problem. They're the result of too much short-term optimism in a fragile market. Now here's where the story gets more interesting. While the token price is struggling, Hyperliquid as a platform is actually building aggressively. One big change is something called HYPE 3. Growth mode. In very simple terms, this allows new markets to launch on Hyperliquid with extremely low fees. The idea is to make it cheap and easy for people to create and create new products instead of controlling everything from the top. This isn't about making money immediately, it's about attracting users, developers, and eventually volume over time. Hyperliquid is also moving fully onto its own blockchain system called HyperEVM and shifting to native USDC instead of relying on other chains. This makes the system more direct and efficient in the long run, even though it can feel like, it's a bit messy during the transition. On top of that, more wallets, apps, and trading tools are integrating Hyperliquid directly. For example, users can trade Hyperliquid markets straight from certain wallets, and other platforms are routing their trades through Hyperliquid because it's fast and has deep liquidity. These integrations don't make flashy headlines like burns do, but they are what actually decide whether people keep using the platform month after month. Another layer to this is how people disagree on what HYPE token should represent. Some see it as a token that benefits from real trading activity because almost all the fees are used to buy back HYPE. From that perspective, if Hyperliquid keeps growing, the token becomes more valuable over time. Others look at the price being down heavily from its highs, and they argue that buybacks don't matter if the market doesn't care. Both views have some truth. Hyperliquid is trying to move from being a hype-driven token to something closer to a business that generates cash flow. That transition is rarely smooth and it often looks ugly in the middle. The ETF filing adds another layer of complexity. A Hyperliquid ETF would let traditional investors get exposure without using crypto wallets or trading directly, on-chain. That's potentially a big deal, but it's not guaranteed, and it doesn't solve short-term sentiment issue. It's a possible future door, not a current solution. All of this is happening in a broader market that's already nervous. Bitcoin is struggling, altcoins under pressure, and general risk off behavior make it hard for any project, even strong ones, to shine. In that kind of environment, positive news often gets ignored while negative price moves get amplified. So, what should you actually take away from all of this? The burn vote matters because it sets clear rules about supply. The upgrades matter because they decide whether people actually use Hyperliquid more in the future. The integrations matter because they bring real activity, not just speculation. And sentiment matters because even the best systems can struggle when fear dominates. Hyperliquid is in the middle of a transition from excitement-driven growth to something more mature and utility-driven. And that process comes with volatility, frustration, and it long stretches where progress isn't affected in the price. Whether it works depends on execution over time, not a single vote or headline. As always, this video is for educational purposes only and is not a financial advice. The goal is to help you understand what's happening and why it's happening so you can form your own view without getting lost in noise or hype. But this is all of you guys in this video. Let me know your thoughts in the comment section and I will see you in the next video. So stay tuned.